Returning to class. Returning to class, we will see right now some other characteristics about global banks and benchmarks. Banks are becoming global after they have been victims of powerful forces. These powerful forces could be called as tendencies or trends in the market. And these trends in the market are related with processes that will produce some kind of changes. In the case of processes, this could be named as consolidation, conglomeration, and specialization. These processes are different and have different characteristics. In these characteristics, we can say about consolidation. Suppose a war. If you are in war, you advance in the enemy's lines and you take their positions. But after you have advanced and take their positions, you need to structure, to arrange your positions, your logistics. You need to have supplies. Then, before you continue your advance, you need to stop, be more stronger in your new positions, and secure that you will receive weapons, guns, and so on, all what you need. The same is in the case of enterprises. The same is the case of financial institutions. As they have grown, they need to check again how are going their processes. If their products or services needs to be need changes or needs to be adapted to the new conditions of the markets and so on. Consolidation is this, or in other cases, if I am working with agencies in some markets or in some segments, I need to know if it's necessary to open branches or subsidiaries or other things. In the case of conglomerations, the case is that I will be operating in the market with different kind of services that are not equal, are not the same. I could be in the market as a bank, and I could be present in the market as a trust company, and at the same time I can be as a securitization enterprise, or I can found or create a stock market agent. In all these cases are different kinds of businesses or related with finance, and I could have insurance companies. And if I want to create more kind of entities, I could create industrial companies or commercial companies that will use the services of all these kind of financial and insurance companies. And as they are not the same kind of entities, as they are in different kind of businesses, as they are using different kind of technologies that in some cases we could say are equal, but not the same. Okay? Similar perhaps, better than equal. And in this case, we are speaking about conglomeration. And when we are speaking about conglomeration, it means that these entities has opened their activities in many other kinds of activities, and after they have done so, they need to check what are they doing again. In the case of lending, when I lend money, it's easy. I check credits, I analyze credits, and I give credits to my clients. But when I am doing some other kind of operations like trading, I will trade financial assets, then the business is different. The risk is another. Then I must adjust my operations, and I must adjust my structure, my policies, my procedures. Then this process will produce changes. On the other hand, we can have specialization. We have seen that we have banks that have specialization in wholesale banking, others in private banking, some others in asset management banking, and so on. There are different kinds of services that they could provide to the market. And when they provide these services to the market, the consequence is that they will produce a change in their structure, a change in their processes, because they are doing something different again. So these processes, consolidation, conglomeration, specialization, will produce some kind of changes in the market. These three kinds of processes, consolidation, conglomeration, and specialization, these three kinds of processes will produce two kinds of changes. The first one in the structure in the financial markets, and the other in the structure of banks. When I am speaking about structure of financial markets, I am saying that at the beginning, for example, exist only banks. Then exist cajas rurales, cajas municipales. Then pymes, financieras. Then stock market agents, stock market societies, financial advisors, financial traders, and so on. Then the structure of financial markets have changed as appear new kinds of participants. And in other cases, if you only lend money, you receive funds from a depositor and you lend this money to a borrower. But right now you are trading. You buy financial assets from someone and you sell it to someone else. Then the financial market structure has changed. It has appeared different kind of participants. They have appeared different services and products that are channelized from different ways, with different processes, with different criteria. It's not the same. It's not the same as analyze a credit than to analyze if it is profitable to buy or not a financial asset. This is a big and important difference. On the other side, when we are speaking about the structure of the banks, at the beginning they only receive deposits and they lend money. Only two basic functions. After this, it has appeared some other kind of functions. They will buy assets, they will advise people in which activities and which financial assets they can invest, and they increase their units. They have a unit of advising, a unit of private banking, a unit of consumer banking, a unit for wholesale banking. They change their structure. They open new departments. They open new units. And when it happens, this change in the structure of the banks will become in the channeling of funds from net lenders to net borrowers. It means that I will lend money directly to someone. And in some cases, these banks will help to this funds channeling, because they will not participate directly, because if they participate directly, it means that they are doing an intermediation operation. They will channelize these funds to someone else. They will advise borrowers from whom they could obtain funds. They will advise others in order to know from whom they could lend money. This is the question. This is what they are doing. And finally, in this other side, we have financial disintegration and securitization. What is financial disintegration? In the case of financial disintegration, I mean that a financial institution at the beginning, for example, a bank, was a bank like a multiple bank, a universal bank. They do every kind of operations. But in one time, the central bank or the SPS will order that if they want to do operations in the long term, they must be investment bank. If they want to operate in a short term, they must be commercial banks. And if they want to operate under the instruction of their clients in order to manage their assets, then they must be a trust bank. So three different activities. For example, these three different activities. And if they want to do three different activities, they must disintegrate their institution and create different institutions. They couldn't be only one. And on the other hand, we could find here securitization. What is securitization? Suppose the municipality of Lima, they obtain incomes from tolls, from other taxes. They are, it is not a good credit client because they never paid on time, or perhaps they never paid. But they have incomes, they have cash, they can pay, but they don't pay. Then, if you want to lend money to the municipality, you are running a high risk. You have only two alternatives. First one, you don't lend money. Second, if you lend them, you will apply a higher interest rate. But if you apply a higher interest rate, the municipality will see that it's not an interesting alternative to borrow money from banks. Then nobody will do a business. How can we do a business with the municipality? If we take away from them, for example, the tolls, peaje, the tolls incomes that they have. Or if we take away taxes about buildings, houses that every year people will pay to them. If we take away from them these assets that are very liquid, that they produce cash in a very easy way, and the municipality gives these assets to us, and in order that we could manage it, it's not ours, it's from them, but we will manage it. And who will manage it? A security enterprise, a securitization enterprise. And this securitization enterprise will administrate it, will obtain all the cash flows from this concept, from these items, and as they have these cash flows, they can secure that they will receive a payment of the debt. Second phase. As they receive this charge, they must administrate this financial assets. They could emitir a bond. They could issue a bond to the market. And when they issue a bond to the market will say, okay, and what is the back of this bond? Because you are a securitization company, but I don't believe much in you, I don't have enough confidence in you. What is the back of your operation? And he said, the back of my operation is the toll. Everyone goes to the Panamericana Sur. Everyone must pay for a toll. A lot of cars go there. So I will have a cash, and with this cash I will pay the interest of these bonds. I will pay the capital of these bonds. Oh, it's interesting. But how do you have this? It's not from the municipality? Yes, but the municipality has given me in order that I administrate it, and with this cash flows, I will pay the interest. Okay, I will buy bonds. And then, the first solution that you have received is that you will receive flows. You will receive funds to finance the municipalities. At the beginning, they don't receive it because they are bad borrowers. Second, as a financial entity, in this case, a securitization institution, will manage the toll incomes, will manage the tax incomes, then we won't have delay the models. We won't have delay in the payments. And if we don't have delay in the payments, the second consequence will be that these institutions will feel that the risk is very low. Then they will charge a lower interest rate. Then we have obtained two solutions. First one, the municipality receive credits. At the beginning, they don't. They don't. Second, they receive it at the lower interest rates. Then, this organization, this kind of operation has created a new kind of entity, a securitization entity. It has created some kind of new operation, someone who will give this financial assets to a securitization institution, and this securitization institution will issue a bond. And people will buy this bond, and these bonds will be paid with the cash that these financial assets are generating. Okay? Then we have a process related with financial disintegration. Financial institutions are divided in many institutions, and the securitization operation is an agent that has helped to this division, and at the same time has created new kind of operations and new kind of institutions. And they have produced at the same kind, by the same way, by the same reason, changes. And these changes have changed the nature of financial intermediaries. The nature, not only a structure. Structure is something that, if we analyze, is always the same. It has changed only because it is bigger, it has new functions, it has new participants. If we are speaking about a building of this university, we have new rooms, we have new roads. That is the university. But in this case, it's the nature what has changed. It's a bigger change. It's not only something related with the structure. And this point will be analyzed in deep in few minutes. But before we do this, we will check another thing. On the other side, we have here two kinds of variables, the positive variables and the negative variables. When we are speaking about this kind of variables, it doesn't mean that they are negative in the sense that we will have negative consequences or that we will have positive consequences. It doesn't mean this. They are classified in positive and variable and negative in function of this in function of this goal, the direct market participation. If the customers, if clients, if everyone could participate in the market, lending money or borrowing money, we have direct participation. What is the advantage of direct participation? That we could obtain higher profits or lower cost, lower financial cost. In this way, we are saying that these variables we produce are positive because they will help to this direct market participation. And these negative variables will produce that we don't have direct participation, we will have intermediation. But on the other side, it doesn't mean that intermediation is bad and disintermediation is good. It doesn't mean this. We have seen in chapter 1 that if we have few difficulties and lower cost, then it's if we have this, we could take an alternative. And in this way, this alternative could be intermediation or could be disintermediation. If this intermediation has the lower cost and the lower difficulties, it means that it is the best alternative for us. These positive variables will help for this one. But on the other side, if we are speaking about negative variables, this could produce that intermediation is the best alternative. So it's arbitrary to say that they are positive and they are negative, because intermediation or disintermediation has advantages and disadvantages. And we will see this in a few minutes. If we see here in positive variables, we can see here open market. And the opposite from an open market is a closing market. Here we can see information technology advances. It means that we could have the possibility to access to this information technology advances. But if we have access to poor information technology, we can use this technology to do our operations, technology to produce, technology for obtaining information, technology for processing operations and so on. And here we have more communication, here less communication. With technology we can have more communication with more advanced technology, and less communication with poor information technology. If in our market we have entities that are like banks but are not banks, it means that we could have more competition. We could have more variety of services. Then the existence of different entities that are similar to banks but that are not banks, then it will produce that we could have more competition, we could have more alternative to choose with whom we will do our operations. But if we have only banks, or banks are the entities that are the most important in the market, then we don't have more alternative. We cannot choose, or perhaps we could choose, but only our alternatives are very few, and so on. And if the market is open, if the market offers a good alternative, a lot of alternative for people or entities to participate in the market, we will have new intermediaries access. New intermediaries access means that new participants could take a share of the market, then we have more competition. But if we don't have more competition and it's difficult to be present in this market, it means that we don't have this competition, and those participants that are in the market are the entities that dominate it. This technology, this open market, this more communication, this other financial institutions that participate in it, and new intermediaries that could enter to the market, will produce more information. And this more information will produce that it will be well distributed in all the market, and then we have symmetric information. Symmetric information means that everyone has the same kind of information, the same quality or similar quality. They will receive this information nearly at the same time. It's not like in our country that someone will receive information previous than others, and they can take advantage over this, and they could do operations at low transactional cost. If you want to lend money to someone, you will assume a higher cost. And if you assume a higher cost, the consequence is that it's not attractive to operate with these operations. Then symmetric information plus low transactional cost, plus these variables that influence over them, because these variables will produce more symmetric information and low transactional cost. Everyone has the same opportunity or similar opportunity to lend, to borrow, to invest, to understand the alternative that you have to invest money. Then we will face bank disintermediation, because we don't need banks to lend money. We don't need banks to borrow money. We don't need banks to know who could invest in our company if we want to invest. If we are productive investors and not only financial investors. But if these other variables are stronger, then those markets, poor information technology, less communication, only banks or nearly only banks, because the other institutions like banks are not present in the market, and it's not easy to be present in the market because you will find many kinds of barriers. Then the consequence will be that we will have asymmetric information. More participants, more technology produce more information and a better distribution of this information, better access. But in this case, we have an asymmetric access. When we have this asymmetric access, it means that people will obtain information easy than others at a lower cost and better quality, and quicker than others, so they can take advantage of this information, the quality of information, the amount of information, the time in which they have access to this information. And if the transactional costs are high, then for small investors, for small borrowers, it's not easy to do operations by their way. They need the help of someone because cost is a high barrier and they can't do these operations. And as they don't have information, enough information to take a decision or to process this information, then these two variables, as asymmetric information, high cost, high transactional cost, will produce that we have bank intermediation. Our country is more a bank intermediation or a financial intermediation market. In other countries like in Europe, in Japan, or in the United States, Canada, bank disintermediation is something that is the pivot of their economy. Not in the number of operations. You will find that the number of operations, bank intermediation has always most operations than the disintermediation market, but in amount they are trading the biggest amount. The most important finance operations are doing through the disintermediation markets. Okay? And continued with this idea, we will see here this cloud that banks originate loans. It's their traditional activity. And when they originate loans, they lend money to someone and they have a loan in their balance sheet. Okay? It was at the beginning. They have loans. They lend money. But if we analyze loans, we can say that they are commodities because the loan préstamo, the loan from one financial institution is similar from some another. And when I lend money to someone, my borrower will sign a note on pagaré. And in this note, they have the compromise to pay. They have agreed to pay at a determined date and interest rates and the capital in the conditions that we have agreed. So when you see the note is the final consequence of credit. We can compare one credit with other. We can say that it's merely a commodity. And we can trade it because we could have the necessity to trade it, or we could see that it's necessary to trade it. We could have many reasons to trade these notes to someone. First reason, suppose that I am a financial institution and I have a limit. I can't lend more than 100,000 soles or 100 million soles. I can't lend more because my capital is not big enough, and the SVS has established a limit, and they said if your capital is at this level, you can only lend until 100 million soles, not more. Suppose that I have right now 95 million. I only have 5 million more to lend. How can I set this? I can't increase my capital. How can I save this problem? I have demand. I can lend money. I have depositors who want to lend money, to deposit money in my financial institution, but I can't lend it because I have a legal restriction. Then the only way that I have is to sell these notes to someone else. I can sell it at discount or over its value. But if I sell it to some other financial institution, they will discover who is my client. He will discover what are the conditions at which I have lent money to him. They will discover the interest rates, the terms, and so on. It's not easy to sell this document to them. The only way is to sell this document or to give this document to someone, to a securitization company. Then the loan can pass to a securitization operation. And this company will receive my loans, my notes, and they will issue bonds. And when they issue bonds, they will receive funds, and these funds will be channelized to me again. Suppose that I give 30 million of soles to this securitization company, and this company sell it as issue bonds, and they will have 30 million in cash. This cash is my cash. Okay? These notes will provide the funds to pay the interest and the capital of this of these bonds. Then, the first reason I do a securitization operation, I give in administration my notes because I can't maintain these notes in my assets because I have a limit. Second, I have lent money to my clients, and when I have lent money to my clients, I have agreed on interest rates and a term. But I discovered, or I have the expectation, that in 2 months or 1.5 months, the interest rate will rise. And if the interest rate will rise, I need to have more funds. I need to disappear these documents. How can I disappear them? I can give these documents to the securitization company again, and when I give to them, they will issue bonds, I will receive more funds, and I will lend these funds in the future at a higher interest rate. So I have again, I have to do a trade because I want to reduce my position in order to obtain higher interest rates. And there could be some other reasons by which I will do this kind of operations, but all of them are pointing to securitization operations. But the bad news about the securitization operations is that this kind of operation has produced the world financial crisis of the year 2007, which consequences are we living right now. And we will be victims of these consequences for many other months. Then, if banks consider that these notes are commodities, they will sell them, they will give in administration, and when they do this, they became brokers of loans. So, this is something different. This is like a change in nature. I was only a lender, but right now I am a broker of something. In this case, the broker of loans. It's not the case that I will maintain my loans until its maturity. And if I retain them until the maturity, it's an asset, it's in the balance sheet. If I channelize them to a securitization operation, it's not in my balance sheet, but I have it, I record it in an account, and a special account, because I have the potential obligation to pay if the notes don't provide enough funds to pay the bonds. So are off the balance sheets, but it doesn't mean that I don't have the potential obligation to pay them if my documents, my financial documents, don't generate enough financial sources to pay them. And as banks became brokers of loans, they are financial brokers. If we do securitization operations, we will give to the securitization operation this notes. And these notes are called underlying financial assets. Underlying financial assets are, in Spanish, activo subyacente. Why activo subyacente? Because when I issue a bond, the source of payment is the note. But nobody can see the note. The note is in the security company. Everyone see the bond, but not the note. Todos ven el bono, pero no ven el pagaré. El pagaré está con la empresa de titulización o securitization. Entonces, then, if you can't see it, it's like something that is under the ground, debajo de tierra, está como oculto, está enterrado. Entonces es subyacente, subyace, le está apoyando, le está dando los recursos para que funcione el bono, pero nadie va a transar, nadie va a comprar, nadie va a cobrar de los que están comprando el bono, nadie se tiene que preocupar de qué pasa con el pagaré. El pagaré está guardado, es el activo subyacente. Okay? And this underlying basis of financial intermediaries is shifting. It means that you will see more and more operations of this kind. You will see that entities are trying to do this operation because it's a need. Because if they don't do so to gain more or to avoid restrictions of limits, they can't do anything. Securitization is the alternative that these financial institutions have. But when they do this kind of operations, they must assume cost of direct participation in financial markets. And this cost of direct participation means that you must pay commissions. You must assume some other kinds of costs like public register, like judicial costs, and so on. You must pay a lot of other costs, and you must estimate them in order to know if it's convenient, if it is convenient to do this operation, or it's better to operate in the traditional way. But you have another kind of cost, the cost of learning, because this operation is new. You don't know how to give this document to the securitization operator. If you do this, you must learn how to prepare agreements, how to negotiate. You need more time and more effort to accomplish with all the conditions of this document. And you need to understand well what are you doing, and if you can't understand it, the consequence could be that you could lose money. And finally, after you have prepared, arranged to structurar this operation, you need marketing monitoring. You need to know how is going the market of these clients that have signed the note, because as they have signed the note, they are the payers of this note. And if they are running a bad perspective, a bad environment, they can't pay. We need to detect, to determine if they can pay or not. And we must know this before we have a problem. We need to monitor this and to prevent difficulties before we have the difficulties. And finally, we are running cost of trading, because we can buy these bonds too. We not only give loans or notes to these securitization companies, we can buy their bonds. And these bonds have a risk. The risk is related with these notes that are administered by this securitization company. And it means, when I am a trader, that I must determine which kind of assets I will buy. In some cases, I will buy long-term, short-term, express it in foreign or domestic currency, in fixed or variable interest rate, or with adjustable principal, and so on. And at the same time, all this asset mix produce a risk, a combined risk, and I need that this combined risk must be optimal. I must buy assets in order to reduce risk, in order to obtain the lower risk with this combination, okay? And at the same time, all the things means that I am running a cost of trading, because the cost of trading is not only the commissions that I must pay to stock market brokers, for example, or to Cavalli and so on. It is related with higher costs that I must assume if the combination that I have obtained in my portfolio is not efficient. Then if it is not efficient, I will have another trading cost related with prices, with market prices that I could obtain if I can't, if I have not produced an adequate mix. So we have seen the new nature of financial intermediaries related with the activities of trading, the activities of giving this financial assets to other companies, and this kind of services will have a risk, and I need to provision risk. What is a provision? A provision is an estimation of the probably losses that I will have with this operation. So I expect that I could have losses. I must estimate these losses, and this is the risk, and the risk that I assume when I offer to the market management services, or when I do management services to my own risk. So the new nature of financial risk means that I need to analyze better the risk that I am assuming, and I must generate a provision in order that I would have enough funds to assume this cost if the risk would be certain in the future. On the other side, I trade and manage financial assets. And when I trade and manage financial assets, I am not only lending, I am doing some other kind of operations. If we are speaking about the United States, in the United States, this kind of trading and management asset represents nearly the 27% of the incomes of these financial institutions, and it is rising. On the other hand, if we see the same concept here in Peru, right now it is 15%. And it is falling, it's not rising. In the year 2009, it was nearly 23%. And before the year 2009, it was rising. So it means that our financial institutions were doing more and more operations every year about asset trading. But after the crisis, the trend is different. They do less of these operations. They perceive that they are very risky operations. And on the other hand, we have in our traditional operations a very interesting profit, a very interesting financial margin nowadays. If we have an interesting margin, why will we run another kind of risk? We can do this, but only if we could obtain an interesting return. And the change in the nature of the financial intermediaries that will evaluate risk and produce and generate provisions, and we are doing asset trading and management, means that financial institutions are financial risk business, not banks. If we think that banks is only an institution who lends, who receives deposits, who opens credit cards, we are wrong. They are financial risk business, like insurance companies. But the difference is that they are measuring the risk of trading in the case of management assets, or in the case of loans, or in the case of letter of guarantee or letter of credit. On the other hand, in my opinion, I could say that financial institutions are not only financial risk business. For me, are entities that are processing information, a bigger concept. Because when they receive financial information, economic information, every kind of information, they process it. And with this information, they can assess the risk that they will run or not. They can determine if they will enter to different markets or not. This information, as they process this information, they will evaluate risk and will evaluate profits, and at the same time, they will evaluate if their actual processes are adequate or not for the environment that they are facing. And when they do all the things, they analyze risk, they take hedging, cobertura, protección. When they take hedging over this risk, they minimize the customer risk. And why they minimize the customer risk? As we are seeing, they are only minimizing their own risk. They minimize the customer risk because if I reduce the risk of my credits, I will recover these funds. And when I recover these funds, I could pay to my depositors their deposits when they withdraw them. By this, I have reduced the customer risk. And when I operate in this way, I will be a sustainable financial institution. And if I am a sustainable financial institution, the consequence is that I will operate, we will say forever. And if I operate forever, it means that those clients that are expecting that I will channelize to them a credit when they need, they could obtain it because I wouldn't disappear before this need, because I have minimized the customer risk through the minimizing of my own risk. And all the things means that I have lower cost. Why have I lower cost? Because I will obtain the adequate interest rates for the risk that I am running. I will obtain the adequate profit from the risk of trading financial assets. Lower cost because compared with the profit that I will obtain, they are optimal. And I am not running bigger cost, higher cost than it is necessary. All the things that we have seen until now are related with financial institutions, with their market, with the structure, with their nature. But they are operating in an environment, and this environment is related with a country, or perhaps in cases like the United States, with states, because in the United States, every state that composes the United States has different laws. And if we want to be a global market, if we want to have stronger financial institutions, we need to do some kind of adjustments. The first one, maximize the benefits of financial globalization. If we think that financial globalization is good for our country, we must take the advantages of this. And why say we that it's an advantage to be global? We said this because if we have open markets, if we are global, it means that our institutions, our financial institutions could participate in other countries, and foreign institutions can come to other countries too. And if it's happened, we have more competition. Everyone, foreign and national and domestic companies, must operate more efficiently. The best thing that we need is to maximize this benefit. And before we take the decision to open our markets, we need to determine which benefits we are trying to obtain. Of course, we will have cost. We must analyze this cost too. And when we are trying to obtain benefits, we are running risk. Every profit, every benefit will produce risk. The meat can with bonds. Then reduce risk of disruption to national macroeconomic policy. Disruption, irruption. When big investors or big financial institutions come temporarily to our country, they will disbalance our balance of payment. And if they disbalance or balance of payment, they can increase the money exchange or reduce it. And when it happens, the consequence is that we will have problems in our exporter or importer sector. Because if we have a big, if a foreign investor channelize a big amount of funds to our country, the consequence will be that the money exchange will fall. And if it's fall, it can produce many kinds of problems. And when they take away these funds again to their country or to some other country, then they will produce another kind of problems to our economy too. So our money exchange wouldn't be stable, and we need to reduce this kind of risk. Then we are trying to maximize benefits, we are trying to reduce risk. How can we do this? First, think not to restrict free flow of funds. Why? If we have a free flow of funds, it means that every investor who is interested in investing in our country will come, and he will bring his funds. When he enters or when they enter, they can produce at the beginning a first disruption, a first problem to the money exchange. But after they have do so, our economy will be stable. And when they withdraw their funds, it will happen a phenomena similar to the phenomena that you could see in financial institutions. Some other investor will come to our country, and when he comes to our country, they will substitute those who are going out. This is the logic to have not restricted flow of funds. New investors will substitute others. We can't guarantee that it will be an efficient method, an efficient technique, because it could be that in some periods we could have big incomes, big international incomes of international funds, and in some periods we could have big outcomes. It could be. But in average, we would have a stable flow. And the other way is that when we have this free flows, because we don't restrict the flow, we need to ensure that these markets and flows are sound and sustainable. We need to create the conditions that will secure that these people will be more stable in our country, that they wouldn't be temporary investors. We must try that they will maintain their investment here. This is the first thing that we need to do. And the second, if we have the people who will withdraw their flows, we need to maintain good opportunities in order that other investors could be interested in come into our country too. So, no restricted flows, and ensure that this flow will be sustainable, because we have markets and flows that are sound and sustainable too. And on the other hand, financial systems need to be prudently managed and supervised. It's a rule that is valid in every country and in every time. Prudently, because we don't need entities that are running higher risk. For example, in the Second World War, those banks who has lent money to their own countries had disappeared. They fall in bankruptcy, because when their states were in war, they don't have enough money to pay their debts. The consequence is that these financial institutions have disappeared. And if they don't disappear, they have lost power, they have lost strength, and other financial institutions that were more prudent, were more conservative, became more stronger, because they didn't have risked their credits in war. So it's necessary to be prudent in the cash management. And we need to manage these entities and supervise these entities in national and in internationally way. Why? Because if they are operating in our countries, it's really necessary to control what they are doing, to monitor what they are doing. But when they operate in other countries, they operate in an international way, it's necessary to control them. Because if they do a bad operations, a big bad operation in other countries, the consequence could be that the headquarters here in our country could disappear, could be in bankruptcy. But we can apply our rules to other countries because we only have management in our country. So we have here a difficulty, not only us, every country. And as we will see in chapter 10, this is something that is the same for developed countries, because as emerged countries has increased their participation, their importance in the financial market, many banks has invested in these other countries too. When we are speaking about globalization, it means that we are operating in our domestic markets. And some way to be global, some way, it's not the only one, is to develop strategic alliances and produce or create or participate in regional markets. By this we have the NAFTA, Mercosur, European Union, and so on. You will find many kinds of regional markets or strategic alliances between countries or regions to increase their operations. And when you do so, you broaden the horizon for many investors, because investors could invest in other countries, and financial institutions can lend in other countries too, and they could obtain deposits from these other countries. If we are speaking about strategic alliances or regional markets, it's not only for products, for minerals, it's for financial and insurance institutions too. They could participate in these other countries too. And it is necessary that both will compete in these other markets, or we will be in an international disadvantage. And when people invest in other countries, or entities will invest in other countries, they grow rapidly. Because if you are only in your country, you could have a lot of money, but you don't have alternative to invest. After this, when you open your markets, when you generate regional markets, you will invest in these other countries in which you could find better opportunities than in your domestic market. And this produces a portfolio diversification. And in some cases, it doesn't mean that you will reduce profits. Perhaps you could increase them, because in these other countries, you will find some economic sectors that are not well exploited as in your own country, and you know them better than their native people. And in this case, it's for you a better alternative. And this could explain why Latin American capital market has grown a lot more than in other regions in the world since the year 990. And with this last slide, we will end today. Small developing countries with fragile banking systems have little to lose from globalization and much to gain. If we are a closed market, we protect all the agents that are operating in our markets. And as we protect them, they became inefficient in a period. If they are inefficient, the consequence is that in the case of financial institutions, they will transfer their inefficiency to other entities. They have higher costs, they have inefficient processes, you must wait a lot of time to obtain a credit. And you must wait because you don't have another alternative. when you open your markets, the competition will produce that these financial institutions will disappear or will adapt to these new conditions to compete and to lend money quicker and to produce a loan at lower cost. Then this produces that the entities that are operating in the real economy will be more efficient too. Okay, this is all for today. Thank you very much. Domínguez. Navarro. Tello. ¿Alguien quiere recoger la prueba de Tello? Agüero.